Welcome to our High Rock monthly video for April. Today, we shall address how financial markets performed last month and what the implications are for your portfolios in the near term, the key adjustments to our models and special mandates, and how managing risk first. That philosophy will be the key to maintaining growth in these uncertain times. I am Scott Tomlinson, and with me today on the call is Paul Tepsich, who founded High Rock in 2010. We started our private client wealth management division exactly 10 years ago in 2015, and we are celebrating that 10-year anniversary. All right, Paul, March is long into the history books, even though it was only a week ago. However, let's have a quick look at what transpired. There was not a lot. Most financial markets were lower in March, led by U.S. equities. Balance mandates were also pulled lower by virtue of that. All of this on uncertainty over the upcoming tariffs to be placed in U.S. trading. Of course, gold and silver as a hedge against risk and volatility have continued to be higher. I don't know if you have any comments on this or
Yeah,
not.
gold, silver is extreme. We own a bit of both in our balance mandates. Um, Silver is extremely volatile, and more of an industrial metal. So well, certainly into April as well, it got hit down, as did gold. But now I'm in April. As we talk on April 10th at 10 a.m., gold it got hit down pretty hard and is right back up. And I think part of that, as you said, Scott, is the flight to quality or safety. But conversely, in times of extreme stress, like we saw in the last 3, 4, 5 days, even gold gets hit just to raise capital. It's liquid. So I think there's a lot of stories. I assume you've seen or read some of them as well about central banks have been buying gold with this trade war going on. So I think that's part of what's driving it higher.
Interesting. Yes. And as we do, we look at the Morningstar average for over 1,000 balanced mandates, just for comparative purposes, so people can look at their portfolios and see how their portfolios are performing relative to these averages. We look at these averages, and in March, of course, they were up or down slightly, which has brought the year-to-date average down. Still positive on the year at the end of March, but that doesn't count for what's happened the last week in April. So we'll just be quick on this. But the one thing to be always aware of is that our first priority is to get the best as we possibly can, risk-adjusted return. So we're always monitoring the risk. And anytime that a client wants to understand their return relative to the risk that we're taking, we're wide open to that conversation. And we do track that for each of our clients as well as the averages. So we have something to compare to. So that's just something that, especially in these extremely volatile times, if anybody wants to understand how their portfolio fluctuates and why, we want to have those conversations. But of course, because you all have very individual portfolios, those conversations have to be had individually. Paul, any updates you want to present on the high yield and preferred share mandates?
Yeah, and the special mandates for the month of March, both high yield held extremely well, even at the end of the month when it was starting to get. I mean, for sure, Scott, in March had some equity weakness as well with these tariffs starting to come through. And it wasn't until early April last week or whatever. I'm losing track of days. Whenever Trump put out his colorful tables in the Rose Garden.
Last Wednesday, a week ago.
It was a week ago. Okay. that's when the market really sank, the equity markets and all markets, quite frankly, everything, which we'll talk about. But up until that point, high yield held in quite well. And preferred shares, the same thing. At the end of March, we were at our high water mark, if you will, like our highest portfolio asset value, net asset value of each account at the end of March. So both of those did really well. Into April, they obviously got hit with everything else, but not brutally. And again, high yield is much less volatile, and it may scare some people. I was talking to a prospective client a week ago who used to own a single high yield bond for 4 years and collected the large coupon interest every 6 months, and in its final year it went bust. Those are horrible stories, but a diversified portfolio with the right credit work, hopefully you don't ever see that. That's for sure. So just to give an idea, our high yield, even for year to date, or pardon me, months to date in April is down like a third of what the preferred shares are down, which are down half of what common equity is down, if you will. So give people an idea for volatility. It's something, as you said on the previous slide, we measure. That's it for those.
All right. As is always the case, we are focused on our clients' long-term goals. If there are any updates or changes, we want our clients to get in touch so that we can review their current wealth forecast and review their investment strategy to make sure that it continues to be in line with their long-term goals. Well, let's talk a little bit about global equity because it has had the most volatility, and there's a pretty good look at the first part of the year. So you can certainly see from last Wednesday till yesterday, there has been a huge swing in equity prices, and you'll see at the prices that have moved the lowest have all been basically U.S. companies, NASDAQ companies, medium-sized and small U.S. companies, all of which we do own, and some of which we have bought as a result of recognizing that there was some value created when the markets came down. Prices were significantly lower, and we stuck our toes in. If you do recall, we have been, when markets are high, when we rebalance, we naturally will sell the assets that are overweight by virtue of being having higher prices and being expensive. And when we sell those, then we have cash, and sometimes we'll choose to sit and wait on that cash until we get more value and better prices. So that's happened this week, especially. So we have been putting some of that money to work. We're a little cautious because we're still in the early stages of trying to figure out exactly what is the end game here for all the tariff increases and how that's going to resolve. So we're picking away at value, as Paul would call it, dollar cost averaging on the way down. Clients who have cash, we're still sitting on some, and that's just our natural caution.
Yeah,
One
Scott,
other,
Scott, I'm just going to add to, patience was key. You did a great job at picking some of these levels, especially on these big downdraft days. We're never going to catch the bottom. It's like catching a falling knife with your hand. It's very dangerous. So when we do buy the big downdraft days, we use some technical charts and points to pick those buy points, and we'll try and stay disciplined at buying the right measured amount at the right big downdraft type days and points on those various securities that we need. But anyway, good job at doing that a few days the past week.
Yeah, I will say that those days feel like a full week. I said to my wife Mary yesterday, I said, it feels like it's a Friday.
It's only Thursday.
Well, today's Thursday. I said yesterday it was Wednesday. I said it feels like a Friday.
Yeah.
It's just like there's been so much going on in such a short period of time.
Well, this is what we get paid for, days or periods like this.
Anyway, one of the metrics that we use is this fear and greed index, and usually it's pretty good for giving us a buy signal when everybody else is selling and there's palpable fear in the marketplace. It's worked in the past. I think it continues to work and will continue to work. So that's another signal for us that we saw happening, and that's why we did a little bit of buying. So
And
as
and
it's bounced a little bit back, but we'll keep an eye on it. If it does start to come down again, then we've got still cash that we can put to work.
And I'm just going to add here on this fear and greed index. It's an interesting 7-factor model. It's from CNN, which some people may think is kind of hokey, but it is a good model. And that we were talking, Scott, earlier this week during the bottom of the selling or the apex of the selling. This thing was sitting at 4, which we had never seen it at. It sat there at 4 for 2 days.
I think it got to 3, maybe.
Okay, and we've never seen that before. And even this morning, as we speak at 10:10, I just updated. It's at 9, which our chart there. At that point when you did it at 7 o'clock, the market was clearly up, and now it's down. So we are still in extreme fear, but that does not mean we go out and spend all our cash and put it all to work, because it can stay here for multiple days and it can get worse.
Well, the one way to look at it too is that there's a lot of risk that's been taken out of the market. So buying when the S&P 500 is at 600 has a lot more risk built into it than buying the S&P 500 when it's closer to 500,
Yeah,
or
thousand,
the
thousand.
SPYs, right? So
Right, right.
the S&P 500 at 6,000 or the S&P 500 at 5,000, there's a significant difference in the amount of risk you're taking when you're buying at 6,000 relative to when you're buying at 5,000. So we're also putting money to work at a place where we're taking significantly less risk.
Yeah, and we have to balance that out with, the possibility of recession, of course.
Yep, absolutely. So, but we'll continue to keep an eye on it, and always our first objective is to protect our clients' capital, but we also want to look for good value for the longer term as well at the same time. Paul, do you have anything you want to chat about for the tactical model?
Yeah, the tactical model, probably, as I said the month before, but 2 of our positions in there, both in energy, continued to weaken. Baytex, which we almost bought yesterday. Unfortunately, we missed that before Trump rallied the markets. And Source Energy, which I've got to call into the CFO to try to confirm a few things. But those stocks continue to be extremely volatile. And then with what OPEC did a week ago or so, increasing production in the face of all this chaos in the capital markets and the possibility of a recession probably around the globe, that was not well received. So oil has been hit pretty hard. And as we speak, it's now back trading below $60 a barrel WTI. So not a stellar environment for a lot of these
On the other
producers.
hand, we've noticed that gas prices around the city of Toronto have dropped significantly,
Well,
which which for
partially the
consumers
carbon
is not a
tax.
bad thing, right?
That well, and you know what? I would bet my last dime that the Trump administration lobbied Saudi Arabia to do just that, increase production. He talked about it before, and I'm sure they did, because that helps out their overall strategy of these tariffs, and which we may talk about in a minute, interest rates. Yeah, it helps out inflation going lower. So
All right. Do you want to
fixed
talk
income.
about fixed income?
Yeah, so fixed income for the month of March, I've already talked about preferred shares. They were quite stable. High yield bonds, in fact, were holding in very well in March. Investment grades similar, but government bonds started weakening a snick at the end of the month, i.e., yields going, well, you can see there, but from the beginning to the end of the month, you can see how yields actually increased a bit. Not a ton, but enough to matter a little bit in our portfolios. Maybe I'll do we have one on the US 10-year yield? Okay, there you go. And maybe I'll just give a 1-minute synopsis here of what's going on. That big, huge dip we've seen now in April. And I know I'm not talking about March because it was reasonably stable, but you can see going back in January, this yield was up at, I believe the peak was 485, or somewhere in there, 4.85% on the 10-year yield. So just to frame this, Trump's been talking about tariffs for 40 years, but the fact that he put them in as quickly as he did, there was actually perhaps some method to the madness. And his Treasury Secretary, Scott Bessent, did the news talk show circuit Friday, Saturday, Sunday, and he explained this, unfortunately for him, extremely well, because what he said was, effectively, we've got $9 trillion of US Treasury bonds maturing this year, 2025. And of that 9 trillion, 6 trillion is maturing in the first half of the year. So what that means is they've got all these bonds, Treasury bonds maturing, and they've got to refinance them. They've got to reissue new bonds to pay for the maturing bonds. And that is an enormous sum. So once he expressed his view that that was his number one concern, that the US did not have a debt crisis. And what happened during the 4 years of COVID is the US Treasury at the time, under Janet Yellen, did not term out or issue longer dated bonds like in the 10 and 30-year sector, like they did through Europe. The ECB, European Central Bank, issued, when interest rates during COVID were down at 50 basis points or lower in the EU, they issued long dated bonds. So they had a long runway before their maturities came. The US did not do that. So it was either do this or risk a debt crisis. So part of these tariffs going in and the market weakening drove, as you can see, just across the month, the end of March, where it went from 440 down to 390. That's 50 basis points or 0.5%. Every basis point saves them $1 billion. So they just would have saved 50 billion. But of course, then he went out on the talk show circuit, and you can see the last 4 days what happened. They absolutely got hammered right back above 440 and got as high as 450. So this is the biggest risk to me in the marketplace right now, is how they refile these bonds and at what levels. They're effectively, it's like having a mortgage come due, and do you want to lock it in at 4.5, or do you want to lock it in at 3.5? So they're trying to get rates lower, but he let the cat out of the bag. I think I'll end it there, Scott.
All right. Well, once again, we have tried to communicate with most of our clients over the course of this week, to just ask them if they need us to have a conversation around how their portfolio is performing and what the risk factors are. Some have taken me up on that, so I've had lots of good conversations, but I certainly am wide open to more conversations, and I would hope that people would engage me in order to, or you, Paul, for that matter, in order to just get a sense of comfort as to how we're managing their portfolios. And you have the ability to get in touch with us at any time. So please feel free to do that. But as always, we are appreciative of the time that you take to listen to our monthly broadcasts. We will be back at the beginning of May for the next one. So until then, I'm Scott Tomlinson. On behalf of my colleagues, Paul and Diane, we want to wish you the very best until the beginning of May.